Well, I'm telling you, the wheel strategy is better than a buy and hold because you can always get things at a discount and you can continuously lower your cost basis throughout the wheel process. Because once you get the shares assigned to you, the 100 shares, you can then do what is called the landlord strategy. You can become your own vacation rental. You can become Airbnb. You can decide to rent out your. So, what I'm going to do is break this down based on the will strategy and the safeguard strategy. The will strategy is a popular strategy that you can Google and you can see a bunch of YouTube videos on it. We have some. There's obviously a lot of others out there that talk about the will strategy. It's a bunch of books that's been written on it. And so it's been exhausted regarding the will strategy. And the reason why is because it is a good strategy. I'm not here to kind of disregard the the the, the strength or the validity of the wheel strategy. It's definitely a good strategy, and it should be done, in my opinion, for most traders. It can even be what most traders should start the options journey with, is the wheel strategy. So I'm going to articulate it and then I'm going to break it down so you can understand the real strategy at a high level. Then I'm going to tell you the comparison or what's different about our safeguard strategy and why we think it's better. So the will strategy is a process of trying to take ownership of shares at less a lesser cost than just outright buying it. So I like to give a comparison. I like to say that you have person A and you have person B, right? And they both have $10,000. Okay? They both have $10,000 and they both are in love with stock ABC. Right now, we're going to say Wynn Resorts. They're in love with Wynn Resorts and they both want to own 100 shares of Wynn. In Wall Street terminology, 100 shares is considered a standard lot. Okay? It's a standard lot. Anything that's outside of that, like 95 shares, 50 shares, it's considered a non standard lot. If you own 100 shares of a company that has options associated with it, then you have the ability to execute the wheel strategy. And I'll discuss that more here in a second. But going back to person A and B, their premise is that they love Win and they want to own 100 shares. So person A decides that they're going to use up all their $10,000 and buy 100 shares of Win that's trading at, let's say, $100. So 100 times 100 is 10,000. So they've used up all their $10,000 to buy Win at the going price, at the spot price, what it's trading at right this second, for example purposes. Person B, on the other hand, has the same premise, but they want to start by utilizing the wheel strategy. And so what they do is they sell a naked put first, or a cash secured put, I should call it, because it's not necessarily uncovered, it's cash covered. So it's a cash secured put. And they sell that put at any price, at any strike price, even if it's in the money. But most of the time, it's going to be at the money or a little out of the money. You can sell that cash secured put, and you're going to instantaneously be able to get the shares of Win for a discount. Your cost basis is going to be instantaneously less than person A. Now, what I mean by cost basis, I mean the price that you are paying to control the shares. So person A is paying $10,000 to control the shares. Person B is paying less than that because they started off by selling the put. When you sell a put, it gives you premium into your account instantaneously that acts as at least a small buffer. It lowers your cost basis from whatever the stock is trading at that point. When you sell a put, you have an obligation to buy the shares. So you already love Win. Your premise is you want to own Win. You just don't want to own it without getting a discount or without owning it at a discounted price. You don't want to pay the going market price. So if you sell a naked or cash secured put and the shares are assigned to you, then you're okay with that. That is safe. That's just like buying the shares of the company that you're okay with owning it into perpetuity. The will strategy, and also what we're going to talk about later, the safeguard strategy, is a better buy and hold strategy. It's better. We all understand through textbooks and what mutual funds and advisors out there try to preach is buy and hold strategy. Well, I'm telling you, the will strategy is better than a buy and hold because you can always get things at a discount and you can continuously lower your cost basis throughout the will process. Because once you get the shares assigned to you, the 100 shares, you can then do what is called the landlord strategy. You can become your own vacation rental. You can become Airbnb. You can decide to rent out your shares, a rent to own type of process on a weekly basis, on a monthly basis, a quarterly basis, or year basis. You decide how you want to do it based on the option expiration periods. But that 100 shares, that standard lot you have, is an asset that you can rent out. And when you rent out something like a house, someone's paying you monies on a consistent basis. And that's lowering your cost basis. Just like if you rented out your house and you had a mortgage on it. Well, that rent that someone's paying you is going towards lowering your mortgage or your cost basis on your mortgage. It is the same concept when you are trading in the open market using the wheel strategy. This part is called the covered call. I like to call it the landlord strategy because of the fact we just talked about. It's a covered call because if you sell a naked call or single call without having the shares, it's considered naked. And that has unlimited, technically, unlimited upside risk because a stock technically can go up forever. They never do. It might feel that way, but they never do. But you're not doing a naked call. You're doing what is called a covered call because when you sell a call, you have the obligation to provide shares to the buyer if assigned, if exercised. So if you already have the shares, then it's covered. Whenever you have to provide shares to someone, you already have it. You don't have to go to the in the open market to get the shares and then to provide it to someone. You already have the shares. So that's why they call it covered call. Right? Covered call. Now, this is the wheel strategy. And it's a wheel strategy because it goes in a wheel of how the process should be. Right? It goes in a circle. It goes in a wheel. And let me explain it. You start off by selling the put. This is the put here. If I sold this put and I sold it at the 100 strike, I will receive $350. So my cost basis will be 96.50, 96.50. So less $350 less than $10 or 10,000. $350 less than person A, as we were just talking about, that paid 10,000 to buy the shares of Win at $100 a share. Now, if Win drops below 100 at expiration, let's just say, you will have to take ownership of the shares with once again, the cost basis of 96.50. If you have to take ownership of the shares, at that point, you'll do the second part of the wheel strategy, and that is selling the covered call. You will have 100 shares, and you can decide where you're going to give the person the ability to rent to own at. So you can sell your call at the 105 in this example and someone will pay you $282. You'll get the appreciation from 100 all the way to 105. You can sell the call at the 110. Someone will pay you $134 for that. You'll get the appreciation all the way up to 110. If it goes up past 110 at expiration, let's use that for example purposes, then your shares will be sold away. You have sold your shares at 110. You get the 134 plus the appreciation up to 110. And then if you still love Win, you do the process over. You go in and you sell the put again. and then it all starts over. It just continues to be a wheel process.
Quick
Now,
question, Ryan.
yes,
This is Kwanzaa. So is it
hey,
best
Kwanzaa.
to, if we are assigned the shares, is it best to sell it right away? Like, do you see what I'm saying? Just to make sure, 'cause
Sell the covered call right away. Yes,
exactly, it is
yes.
best because it could change as far as like it could decrease in price.
Correct. It can go down
Mhm.
more, and if it goes down more, you want to have that little cushion that the call gives you when you sell it. So absolutely, you want to
Okay.
sell the call.
But you
And
don't
you can decide where you want to sell it at based on the examples I was just giving for example purposes.
but
Okay.
you don't sell the call until you've exercised the put and acquired the shares.
Correct. You wouldn't sell the call until then, because if you sell the call before then it could be what is called the naked call, right? So you have
Right.
technically unlimited risk to the upside. So it's not covered at that point. Then it doesn't become safe. It doesn't become safer than a buy and hold. And so the premise to me with will strategies is to be safe. And that's why I'm saying someone who's beginner with options, this is an excellent way to learn options. And then it's an excellent way to continue to do this into perpetuity. I know when I first started learning options, I started with the cash secured put, and then obviously moved on to the covered call. The next step to this, you guys, is that one of the bad problems, one of the issues with the wheel strategy is that if the stock falls too much, and then people get they start to hate the wheel strategy because they feel like their call space is off. I tell people just make sure you keep a record of your call space and just keep selling calls against it. If your calls are taken away, come back in with a put again, but just keep the record of your call spaces. You're gonna get it back. If it's a good company, you're gonna get it back. And this is what you should be doing these on as good companies. If you're going to do it on a company that's a lot less speculative, or if you're going to do it on a company that's good, but you feel it has some really a lot of headwinds in front of it and a lot of negativity around it, then this third strategy that we have added to the wheel strategy here at the Dorian Trader that we call the safeguard strategy is called the collar strategy. And this collar strategy is a bullish strategy, just like the selling of the put and the selling of the covered call. The collar strategy is bullish, but it limits your downside. When you do a when you do a naked or cash secured put, you have risk technically all the way to zero. When you do a covered call, you have risk technically all the way to zero. When you do a collar, you don't have risk all the way to zero. You can define where you want your risk to stop. So let me explain it. A collar strategy is the COLLAR, right? That's the collar strategy. It it is doing the covered call, you selling a covered call, then you taking some of those monies from the call that you sold. This is the call you sold here, and you're buying a put. So in this example, let's say you're receiving $282 to sell this call, and then you're going to buy a put for no more than $282. So for example purposes, if I bought this put here at the 95 strike, that means once if my call spaces, I just say in this example, my call spaces are where I sold the put at initially was at $100 or the 100 strike. Well, I stop losing. I stop losing once it goes down 5%. Someone else technically has risk all the way to zero, but I can't lose anymore after it goes past 95 because this put gives me a right. This is why you need to understand the base of options. This put that I bought gives me the right to sell at the 95 strike. So I have 100 shares. If it goes up, I have the obligation to sell my shares at the 105. So that's where I stop winning at the 105. I have 100 shares. If it goes down, I have the right to sell at the 95. So that's where I stop losing. So this is it's kind of like a bracket trade. I'm limiting my downside and also I'm limiting my upside. I'm bracketing off both sides of the trade.
But,
But
but
this way,
this assumes you own the shares, though, right?
yes, this is you own the shares at this point, right? You sold the potentially you sold the cash secured put and you have the shares, or you started off with a covered call and you have the shares, or whatever the case may be, you have to have the shares at this point. You have the shares and you're just trying to protect yourself to the downside. So in my world, I try when I'm doing these collars, I try to protect myself 5, 10, 15, 20% down. Right? So 10% is considered correction in Wall Street terminology, 20% is considered a bear market. So I'm trying to minimize my downside and render. This is where it kind of comes. It's kind of subjective, right? So you might say, okay, I'm okay with losing, risking 10% of this stock going down 10%. Someone else might say, I'm not okay with that. I only want to risk 5%. Or someone might say, oh, I'm okay with risking 20%. It all depends on the individual. But this collar strategy gives you more control over the downside, which I absolutely love. I love having control. I love being able to feel like, okay, if the market's going to tank, I'm going to be fine because I know my risk is defined. I didn't mean to rhyme there. So, but you guys get my point. So this is the collar strategy. I'm going to go into too much more detail unless you guys have some questions, but we have some really good videos in the video library that everyone gets access to as a member of the Dorian Trader under the safeguard strategy in the video library. We have several videos going in great detail, I believe, in this on these strategies. Go ahead. All right, so that was the collar strategy. So with the traditional wheel strategy, you have no way to limit the downside from being all the way to zero, right? With the traditional wheel strategy, you have no way to limit the risk being all the way to zero or stop the risk from being all the way to zero. With the collar strategy, you can do that. You can limit your risk to a percentage that you think is acceptable for yourself. Now, with the traditional wheel strategy, you do not have the ability to have unlimited upside potential. You do not have the ability to have unlimited upside potential. When you sell the cash secured put, the most you can make is the premium you received. When you sell the covered call, the most you can make is up to the call that you sold. Now, at the Dorian Trader, we throw in this fourth and last strategy that we encompass into the safeguard strategy. In this strategy, we call it the bond and pool that Ernie created for us years back, that gives you unlimited upside potential. So for example purposes, we were using the same win. If I sold this win put at the 100 strike, I just say someone's paying me $350, I can buy a call for no more than $350 and have unlimited upside. So if I bought this call at the 105, I now technically have unlimited upside. As you can see, max profit is not defined, it's undefined, because I have unlimited upside now because of the call I bought. When you buy a call, you have the right to purchase shares at the strike price and you have unlimited upside. When you sell a put, you have the obligation to buy shares at the strike price. So this is just like this, the kind of risk associated with this trade is just like selling a cash secured put. The only difference is that you have unlimited upside now. The cash secured put, you can only make the premium that's received. So in this example, we're going to receive $73 still. Our cost basis is still going to be 73 cents less than person A we were talking about earlier that bought at $10,000. But just like person A who bought the shares, we have unlimited upside over the next 33 days for a lower cost basis. So to me, this is an amazing type of addition to what we call the safeguard strategy, because you get the cash secured put, you get the covered call, you get more protection to the downside with the collar strategy. You get unlimited upside, but still being able to lower your cost basis and have the same risk, if not less risk, than a person who just outright buy the shares, usually less risk, and still have unlimited upside. So you have to decide on which of those four strategies you're going to initiate a trade with. You can do the cash secured put. You can do all those four strategies initially, but once you have the shares, you can only do the covered call or the collar strategy.